Audit procedures are systematic techniques employed by auditors to obtain sufficient appropriate evidence supporting the opinion expressed on the financial statements. Under ISA 330, the auditor's responses to assessed risks, and ISA 500 audit evidence, audit procedures are designed in response to identified risks of material misstatement and are classified broadly into tests of controls and substantive procedures. While tests of controls evaluate the operating effectiveness of internal controls, substantive procedures are performed to detect material misstatements directly within financial statement balances, classes of transactions, and disclosures. The auditor determines the nature, timing, and extent of substantive procedures based on assessed audit risk, materiality, and the effectiveness of internal controls. Consequently, substantive testing remains an essential component of every audit engagement because international standards on auditing require substantive procedures for each material class of transactions, account balance, and disclosure regardless of the assessed level of control risk. Substantive procedures consist of tests of details and substantive analytical procedures, both of which provide direct evidence regarding the fairness of financial statement assertions. Tests of details involve detailed examination of transactions, balances, and supporting documentation to verify existence, completeness, valuation, accuracy, rights and obligations, and presentation. Examples include inspection of invoices, contracts, bank statements, inventory count sheets, fixed asset registers, and legal documents, together with external confirmations of receivables, bank balances, and legal claims. Auditors may also perform recalculations, reperformance procedures, or physical inspections of assets to obtain highly reliable evidence. The extent of detailed testing generally increases where control weaknesses exist, materiality is low, or inherent risk is assessed as high due to complex transactions or fraud risk factors. Analytical procedures may also be used as substantive procedures where relationships among financial and non-financial data are predictable and sufficiently reliable. Substantive analytical procedures involve evaluating plausible relationships and investigating significant fluctuations or unexpected differences between recorded amounts and auditor expectations. These procedures are particularly effective where transactions occur consistently over time and internal controls operate reliably. Auditors compare current financial information with prior periods, budgets, forecasts, industry averages, or independently developed expectations to identify unusual movements requiring further investigation. Analytical procedures provide efficient evidence over large populations of transactions while reducing the need for extensive detailed testing where expectations can be developed with sufficient precision. Examples of substantive analytical procedures include comparison of gross profit margins with previous years to identify possible inventory valuation or revenue recognition errors, analysis of payroll expense trends relative to employee numbers, comparison of depreciation charges with non-current asset balances, review of interest expense relative to borrowings, and examination of inventory turnover ratios to identify obsolete stock or valuation issues. Similarly, receivable collection periods may be compared with prior years to identify potential impairment issues, while utility expenses may be compared with production volumes to identify recording errors or unusual operating conditions. Where significant unexpected fluctuations arise, auditors perform additional inquiries and substantive testing to determine whether material misstatements exist. Consequently, analytical procedures complement detailed testing by identifying areas of elevated audit risk requiring further investigation. A particularly challenging area of substantive audit work involves the audit of accounting estimates, which frequently involve significant management judgment and estimation uncertainty. Accounting estimates include provisions for litigation, expected credit losses, warranty obligations, inventory obsolescence, pension liabilities, impairment calculations, depreciation estimates, fair value measurements, and asset useful lives. Because future outcomes cannot be predicted with certainty, management estimates are inherently subjective and susceptible to both error and deliberate bias. Auditors therefore evaluate whether estimates are reasonable within the context of the applicable financial reporting framework and whether assumptions used are consistent with available evidence and external market information. Significant estimation uncertainty increases the risk of material misstatement and often requires enhanced professional skepticism. The audit and review of accounting estimates presents several practical difficulties. Management assumptions may be overly optimistic or intentionally manipulated to achieve desired financial results, making objective evaluation challenging. Reliable external evidence may be unavailable, particularly where unique assets or uncertain future events are involved. Complex valuation models often require specialist expertise in actuarial science, engineering, property valuation, or financial modeling beyond the auditor's own technical competence. In addition, changes in economic conditions or regulatory environments occurring after year-end may influence estimate reliability. Auditors respond to these challenges by reviewing management's estimation process, testing underlying data, evaluating assumptions, considering subsequent events, developing independent estimates, or engaging external experts where appropriate. The audit approach adopted for smaller entities often differs from that applied to larger organizations because smaller businesses typically possess less formal internal control systems and simpler organizational structures. Segregation of duties may be limited due to fewer employees, while owner-managers frequently participate directly in operational and financial decision-making. Documentation may be less sophisticated, formal policies may be absent, and reliance on personal supervision rather than formal controls is common. Although owner involvement may strengthen oversight in certain circumstances, management override and concentration of authority may simultaneously increase fraud risk and reduce the effectiveness of internal controls. Consequently, auditors generally place less reliance on control testing and perform more substantive procedures when auditing smaller entities. Evidence available within smaller entities may also differ significantly from that available in larger organizations. Formal policy manuals, extensive management reports, and sophisticated information systems may be absent, requiring auditors to rely more heavily on external confirmations, bank statements, tax filings, supplier invoices, customer correspondence, physical inspection of assets, and direct inquiry of owner-managers. Because internal documentation may be limited, evidence obtained from independent external sources often assumes greater importance in supporting audit conclusions. Auditors may also perform additional substantive analytical procedures and expanded tests of details to compensate for weaker internal controls and reduced documentation. The distinction between tests of controls and substantive procedures is fundamental to understanding the audit process. Tests of controls evaluate whether internal controls have been designed appropriately and operated effectively throughout the reporting period, providing evidence regarding the reliability of the entity's control environment. In contrast, substantive procedures seek direct evidence regarding financial statement assertions by detecting material misstatements in transactions, balances, and disclosures. While effective controls may reduce the extent of substantive testing required, substantive procedures cannot be eliminated entirely because auditing standards require direct verification of material financial information. Together, tests of controls and substantive procedures provide complementary sources of audit evidence that enable auditors to obtain reasonable assurance and express an independent opinion on the fairness of the financial statements.